Very good morning, everyone. Once again on this beautiful Sunday morning, I'm welcoming all the participants to the Valuation Manthan session 28, which is on valuation of trademark. This Valuation Manthan, it is a very great initiative of our Valuation Standards Boards of ICAI. It's under the leadership of its chairman C.A. Hansraj Sukhsarji and its vice chairman C.A. Priti Parasavla, and which is for the benefit of all the existing as well as aspiring registered valuers, as well as all those present today for the session. Due to some commitments, our Honorable Chairman C.A. Hansraj Sukhsarji and Vice Chairman C.A. Priti Savla Madam is unable to join today. I'll give a brief introduction of our Honorable Speaker today, C.A. Joy Kumar Jain. C.A. Joy is a CA, Chartered Accountant, CMA, Insolvency Professional and a Registered Valuer. He has an overall post-qualification experience of 35 years plus. He has sound technical knowledge in valuations, transaction services, corporate restructuring, accounting and corporate law matters. He is a founder and director of Joy Financial Consulting Private Limited and sole proprietor of Joy Jain and Company Chartered Accountants. He is presently focusing on valuation, accounting advisory, transaction services, and corporate restructuring services. He is also an Ind AS and IFRS specialist. He was an independent director on board and member of audit committees of few companies. He worked for PricewaterhouseCoopers members firms in India and overseas for over 27 years, including over 15 years as a partner. With this brief introduction, I request our honorable faculty and speaker for today, C.A. Joy Kumar Jain, to start the session. Over to you, sir.
So before
Thank you so
Mr.
much.
Joy,
Sorry, madam.
Before-
Yes, please. Good morning, ma'am.
Good morning.
Good morning, Mr. Joy and Anisha. So I'll just welcome all of you before Mr. Joy starts. I'll take a minute's time and welcome all of you to this Valuation Manthan series. And it's our endeavor to serve all of you the best Sunday morning. Since the more than 25 sessions we have already done. And today, Mr. Joy will take us through the journey of valuation on trademark. So welcome, Mr. Joy, and welcome all of you. And if you, I think he'll also take all the questions at the end of his session. And friends, you will be also sharing all these presentations on our ICI channel, TV channel. So please, if you want to connect later on, also you can connect through and go through this video links. So welcome once again, and over to Mr. Joy.
Good morning, and thank you, Savla, and thank you, Anisa, for your kind words. And I would also like to take this opportunity to thank Ms. Savla, Mr. Chug, as well as the Valuation Standards Board of ICAI for giving me this opportunity. And with this, I would like to start my presentation. If I can just get a minute to share my
Sure.
screen. So I hope you're getting the full screen now.
Yes, sir.
Yeah.
So the topic of the day is valuation of trademarks. And what I would like to cover is what is the definition of a trademark? What does a trademark mean? What is the need for valuation of a trademark? What is the accounting for trademarks? Because that is interlinked with the valuations. And what are the definitions of value that we will encounter for the purposes of doing valuations of trademarks. Then finally, the valuation approaches and methods and a few examples of how do we do those valuations. So coming first to the definition of a trademark, if we start with, there are various definitions actually, and if you go to Google, you will find multiple websites giving different definitions. So I've just selected a couple of them. First is in investopedia.com, which says the term trademark refers to a recognizable insignia, which is some kind of a mark, phrase, word, or a symbol that denotes a specific product and legally differentiates it from a product of its another product of its kind. So the important point is legal differentiation here. A trademark exclusively identifies a product belonging to a just a second. A trademark exclusively identifies a product as belonging to a specific company or a specific enterprise, we can say, not necessarily a company, and recognizes the company's ownership of the brand. Trademarks are generally considered a form of intellectual property and may or may not be registered. But mostly, if you go through the law, most of the laws require trademarks to be registered. We'll sort of look at that going forward. Um, then World Intellectual Property Organization defines a trademark as a trademark is a sign capable of distinguishing goods or services of one enterprise from those of other enterprises. Trademarks are protected by intellectual property rights. So when we say intellectual property rights, normally these are legal. So there has to be a legal backing for a trademark to exist. Now, then we also have in India Trademarks Act 1999, and it gives certain definitions. So first of all, before we come to the trademark, it defines certain items which are included in the trademark. First is a mark. Mark includes a device, brand, heading, label, ticket, name, signature, word, letter, numeral, shape of goods, packaging, or a combination of colors, or any combination thereof. So you can see it is very wide. It can include virtually anything. And name includes any abbreviation of a name. And package includes any case, box, container, covering, folder, receptacle, vessel, casket, bottle, wrapper, label, band, ticket, wheel, frame, capsule, caplet, stopper, and cup. So virtually the trademark includes all these things, can include all these things. And this is the definition of trademark under the Trademarks Act. A trademark means a mark capable of being represented graphically and which is capable of distinguishing the goods and services of one person from those of other, and may include shape of goods, their packaging, and combination of colors. So basically, it is meant to indicate a connection in the course of trade between the goods and services, as the case may be, and some person having the right as a proprietor to use the mark. So this is where basically for the first point is for offenses, for the chapter of offenses and penalties. The chapter 12 referred to here refers to offenses and penalties. And then for everything else under the act, the definition talks about a mark which indicates or so as to indicate a connection between the course of trade between goods or services, as the case may be, and some other person having the right either as a proprietor or by way of a permitted user. So a person who is a licensee, somebody who is using the brand, say for example, if we take McDonald's is an American company, but we have McDonald's in India. So the Indian company which is using the McDonald brand or trademark is a licensee, is a permitted user. So that is also covered. So to use the mark, whether with or without any identification of the identity of that person, and includes certification marks or collective marks. So collective marks or certification marks are like, we have this marks called ag mark or for wool mark and things like that. So they are certification marks, basically certifying the purity of the products. And collective marks refers to marks of trademarks of association, basically. And then there is also a concept of well-known trademarks, something which everybody knows and everybody sort of follows. So most people know about it. For example, if we talk about detergents, people will normally say Surf. Or if we talk about looking at something on a website, on internet, people will say Google it. Or for photocopying, people might say Xerox it. So those are well-known trademarks. Then if we look at the US Patent and Trademark Office, it also has a similar definition. A trademark can be any word, phrase, symbol, design, or a combination of these things that identifies your goods or services. It's how customers recognize you in the marketplace and distinguish you from your customers. The trademark can refer to both trademarks and service marks. A trademark is used for goods while a service mark is used for services. A trademark identifies the source of your goods or services, provides legal protection for your brand, helps you guard against counterfeiting and fraud. So the reason why I've given, say, a US example here is because different countries may have slightly different definitions. And if we are doing valuation which involves an international transaction or where a brand or a trademark may be registered in another country, then we need to look at the law of that country. And these are just some examples of trademarks. Hmm. Then normally when you would look at the trademark, you would either see a TM symbol appearing next to the trademark, which normally means that the registration application for the trademark has been made. And it serves as a warning for infringers, copycats, duplicates, and counterfeiters. Or normally there is a R symbol that you would have seen, a round circle with an R in between. This basically signifies that the trademark is registered and it is protected under the Trademark Act. Normally, some places you will also see that it is the R is not appearing or the TM is not appearing next to the mark, the logo or whatever. It may be appearing as a small note at the bottom of the label or at the bottom of the box or somewhere. So IFRS, if you look at IFRS starts with when it says marketing related, the first thing that's mentioned there is trademarks, trade names, service marks, collective marks, certification marks. And so this is the first thing that is there in IFRS example for an intangible asset. And these are also given under ICI valuation standards as well as under international valuation standards. They are also mentioned there. And IFRS, when I say IFRS, it is so India doesn't specifically give these examples, but IFRS has an appendix which gives these examples. Then what is the difference between a brand and a trademark? So if we, we talk about brands and today we are talking about trademarks. So what is the difference? Brand is a more generic word and it is a wider term than a trademark. Key difference is that the trademark is legally protected. It is a registered item while a brand may or may not be registered. And brand is a generic thing. It may sort of not only necessarily denote a product or a service, it may also denote an organization. For example, if we talk about Tata Group or Birla Group, they are themselves brands today. Or even Reliance. Then all brands are not trademarks, but all trademarks are brands. And registration of a brand is not necessary. Registration of a trademark is necessary. And the objective of brand is to aid in identification of a product and to give it uniqueness and differentiation, while the objective of a trademark is to stop duplication and copying of the product. So basically, trademarks are those which are giving you a protection from others. And I will also talk about a couple of sections from the Trademarks Act, which talk about what protection is available. So Section 25 of the Trademarks Act provides that the duration of a registered trademark is 10 years, but it can be renewed from time to time. So on payment of fee and prescribed and complying with prescribed terms and conditions, which means that a trademark can go on infinitely. If the companies or the organizations keep renewing them, then the trademark can go on infinitely. Then Section 28 of the Trademarks Act provides that subject to other provisions of the Act, the registration of a trademark shall, if valid, give the registered proprietor of the trademark the exclusive right to use the trademark in relation to goods and services in respect of which the trademark is registered, and to obtain relief in respect of infringement of the trademark in the manner provided by this Act. So this is the protection that is available to a trademark. So one, it gives the exclusive right to the holder, and secondly, the holder can obtain relief in respect of infringements. We keep reading in the newspapers that various companies have sued other companies for copying of the trademark or passing off, or the word used is passing off or passing off, and then the courts have given them relief. They have stayed the the other companies. They have stopped other companies from using those copied trademarks. So this keeps happening. The exclusive right to use the trademark given shall be subject to any conditions or limitations to which the registration is subject. So that depends upon the registrar of trademarks. A key issue that I would like to mention here is that a trademark is with respect to a specific product or a service or a group of products or services. So, for example, if I take a trademark for biscuits, it will not be applicable for a car or for something else or for detergent. So, if a company manufactures all the different things and they want us to use a common trademark, then they will have to get the trademark registered separately for each of those items. Otherwise, if one person is using the trademark for a biscuit, say for example, if I talk about Parle G, then somebody else can use Parle G for a detergent powder or clothing brand or something else. Section 27 of the Trademark Act provides that no person shall be entitled to institute any proceeding to prevent or to recover damages for the infringement of an unregistered trademark. So, if there is a brand which is not registered, basically, so a mark or a logo which is not registered, then there is no protection available against it. A third party can use it, and the user of the brand, the original user of that logo or the mark, cannot do anything about it. So I will just okay. So I can take some question and answers if there are any right this point, or if none, then I can go ahead. I'm going rather fast because I want to concentrate more on the valuation approaches and methods
We
later
have
on.
not received any question.
Okay, okay.
You can
Yeah. Okay, so I'll go ahead. Yeah. So now we come to why do we need valuations for a trademark? First of all, is assist the buyer or a seller in negotiation of a price in case of a transaction. So if somebody is buying or selling a trademark, then to help them arrive at a price. Then in case of a litigation, so somebody may want to recover compensation to come to what should be the amount of compensation. Settlement between parties or family settlement. Sometimes for family-owned businesses, originally the family may have a one common trademark that is being used, and then when the family's patriarch or matriarch passes away, and then there is a settlement between the various heirs, then the issues always arise as to who will use that trademark, and then a valuation may be required because either one party may buy out the other party, or they may agree on some other arrangement. A common example here is Reliance. So if you remember, after the passing away of Mr. Dhirubhai Ambani, then both the brothers had a feud and ultimately they settled, and they were both allowed to use the Reliance brand name, except that the way they wrote Reliance, the logo changed. So similarly, in Delhi, there is another example. There is a very famous ice cream called Gyani's. And again, the same thing happened. And ultimately, when the hair split up, they both were using Gyani's, but they are using Gyani's differently, as you can see in this slide. So these kind of things happen very commonly, family settlements, and then they have to sort of discuss about brand and what to do. And sometimes one party may buy it over, or sometimes they may decide to use the same brand but slightly in a different manner, making minor changes. Then, of course, the valuations of a brand is required for accounting purposes, for either when it is acquired as a single asset or as a group of assets. So you need to do a purchase price allocation. Or when a business is bought, again a purchase price allocation needs to be done, and In these cases, we need to do a fair valuation of all the assets and liabilities acquired and then allocate the purchase price. Fair value reporting under evaluation model. So this is allowed under Ind AS 38, which is for intangible assets. But the conditions are very strict, so it is rarely applicable. But it is there. But this is allowed. And then also we may need to do valuation under for impairment testing purposes. Excuse me. Then going forward, valuation would be required under Companies Act where shares are issued for non-cash consideration. That is where shares are issued as a consideration for purchase of a trademark. So valuation is required both for the shares to be issued as well as for the trademark being acquired. Then for insolvency and liquidation purposes under the Insolvency and Bankruptcy Code, because it requires valuation of assets, fair valuation and liquidation value. And for taxation purposes under income tax or for GST for payment of appropriate taxes. So if we look at income tax, there are a number of places where a valuation of intangible assets or trademarks may be required. One is when there is an acquisition of a trademark or a group of assets is acquired together, including a trademark, or acquisition under a slump sale. So when a whole business is acquired and that includes a trademark, under demerger accounted for under Ind AS, because in Ind AS we have to follow business combination accounting and we have to do fair valuation of all assets and liabilities acquired. So if any trademark is acquired, that also needs to be fair valued and accounted for. Under amalgamation demerger, which does not meet the definition of under the Income Tax Act, because in such cases there is no need to follow the book value method. Then, if there is a related party transaction in an armed in income tax which involves transfer of a trademark, in that case, again, arm's length valuation may be required. And lastly, under 56(2)(7)(a)(b)(a)(2), if valuation of shares is based on valuations of the assets of the company. So this is, there is a DCF method, there is a NAV method, and there is a third method which says that valuation can be done based on valuation of the assets of the company. So there, if there are trademarks in the company, then those would need to be valued. And when we talk about the first or second point, then we have 56 not for a business, but otherwise 56(2)(10) comes into play, which requires that assets have to be acquired at if they are acquired at lower than face value, then the buyer has to pay. Then the difference will be treated as income from other sources. So those are the issues that arise under income tax. Then if for accounting purposes, okay, yeah. So now coming to accounting, fair valuation and accounting are quite interlinked. And so we need to understand what is the accounting and then where the fair valuation is required. Well, initially for internally generated assets such as trademarks, they cannot be accounted for. So only acquired trademarks are normally accounted for, and only if they meet certain criteria for being classified as a intangible asset. First is identifiability. That is, they are clearly distinguishable from goodwill. So first is either they are either separable or they have legal rights. So when we say separable, that means they can be rented out, sold, exchanged, or distributed. And then there is control over the asset. So the holder has the power to obtain future economic benefits from the asset, usually on the basis of legal rights. And lastly, the asset will have some future economic benefits. So if these three can be demonstrated, then the asset can be accounted for. Then if we look at a business combination, in a business combination, Ind AS requires that the intangible asset or a trademark can be accounted for if it meets the conditions of identifiability, which is contractual, legal or separability, and future economic benefit is not separately mentioned because it is already embodied in the fair value of the asset. So while Ind AS specifically mentions that the identifiability criteria to be met, there is nothing like that under AS, the old accounting standards. So there we still have to meet all these three accounting criteria, all these three criteria, even under a business combination or amalgamation. Now we look at the definitions of fair value. Now the definitions are important because it depends upon the purpose for which the valuation is being conducted. Hmm. So because and there are separate definitions for different purposes. So we have the old accounting standards are now under accounting standards under Companies Act Accounting Standard Rules 2021. So they have certain definitions. Indian Accounting Standards has one definition. Income Tax Act has another definition. Insolvency and Bankruptcy Code has another definition. ICICI Valuation Standard has the same definition as the Indian Accounting Standard. And International Valuation Standard refers to various other definitions. So depending upon the purpose, we will have to use the what is the most appropriate fair value definition. So coming to the accounting standards, the old accounting standards, so the definition, fair value definition is given in three standards: AS10, AS14, AS26. AS10 says, which is property, plant, and equipment, fair value of an asset is the amount for which that asset could be exchanged between knowledgeable willing parties in an arm's length transaction. And the same definition is given under in AS26 also. But AS14, which is accounting for amalgamations, has a slightly different definition. Fair value is the amount for which an asset could be exchanged between a knowledgeable willing buyer and a knowledgeable willing seller in an arm's length transaction. So it is talking about a buyer and a seller here, while other definitions are only talking about parties which may or may not be buyers and sellers. And then there are certain issues if we look at these definitions as compared to the definition given in Ind AS 113, which is the fair value measurement standard. So the issues that we have is whether the parties are independent of each other, whether the parties have the ability to enter into a transaction, whether buyers can arrange the funding, or whether the seller has assets which are free of encumbrances, whether there are synergies available to the seller, whether they should be should or should not be considered, whether the buyer or a seller is forced or compelled to do a transaction, and it may or may not be a sale transaction. So there can be an exchange otherwise also. So this makes it that the definition under the accounting standards is relatively loose compared to the definition under Ind AS 113. If we look at Ind AS 113, so para 9 gives the definition. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So it is talking about selling of an asset. So we are clearly talking about a sale or a purchase. We are talking about an orderly transaction, and we are talking about market participants. So basically in a market and at the measurement date. So date is also specified here. So the definition is further expanded in paragraph 24, which says fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction in a principal or most advantageous market. So here they've clearly mentioned the market at the measurement date under current market conditions. So that is the exit price. So basically we are concerned with the selling price here at which the seller will be able to sell, regardless of whether that price is directly observable or estimated using another valuation technique. So if there's something which is readily bought and sold in the market, we use that price. And if there is a good which is not readily bought and sold in the market, we will use a valuation technique. So Ind AS 113 further says that a fair value measurement is for a particular asset of a liability, and therefore, when measuring the fair value of an entity, shall take into account the characteristics of that asset or liability if the market participants would take those into account. And such characteristics include the condition and location of the asset and the restrictions, if any, on the sale or use of assets. For example, in the case of a trademark, it would be something like what kind of a trademark it is, what business, then whether it is a growing business or a declining business, that will affect the value of the trademark. Then restrictions would normally come in the case of if it is a licensee. So whether the licensee can further transfer the license to somebody else or not. And in certain cases, we have seen that the brands are also, or the trademarks are pledged. Kingfisher Airlines was a classic example. Then also, when we were talking about market, India's 11C says that we have to sort of consider the principal market for that asset or liability. And in the case of a principal market, we have to consider the most advantageous market. However, for intangible assets and trademarks particularly, we don't have any specific markets as such. Hmm. Because there are very few transactions. Hmm. And the measurement should be based on the assumptions that market participants would use when pricing that asset or liability, assuming that the market participants act in their economic best interest. So, whoever the potential buyers are, we have to assume what assumptions they will make to make this purchase. And a fair value measurement of a non-financial asset, because a trademark is a non-financial asset, takes into account a market participant's ability to generate economic benefits by using the asset in its highest and best use. So for trademark or any other non-financial asset, we have to see what method or what use will give the highest value, and then consider that only. So it could be the company using the trademark itself and selling the products or services and earning revenue, or it could be the company licensing the trademark to other parties and getting a royalty income. So one would have to consider the alternatives to see which one gives the highest value, and then consider that. Then we come to income tax. Income tax has a definition of fair market value under Section 222B, which says fair market value in relation to a capital asset means the price that the capital asset would ordinarily fetch on sale in the open market on the relevant date. So they are only talking about the price that will be fetched in the open market on the relevant date. And where the price referred to in subclause 1 is not ascertainable, such price as may be determined in accordance with the rules made under this Act. However, there are no rules which have been prescribed for this purposes. Well, there are rules for shares and other items under Rule 11 UA, but not for intangibles. The only thing that I could find in relation to income tax is ICBS V or 5, tangible fixed assets, which again defines the fair value as the same which is given in accounting standards. Fair value of an asset is the amount for which that asset could be exchanged between knowledgeable willing parties in an arm's length transaction. And then we come to IBC. Now, IBC definition is somewhat different from the definitions that are given under the accounting standards or even the income tax. Fair value means the estimated realizable value. So here they're talking about realizable value and not the selling price of the assets of the corporate debtor if they were to be exchanged on the insolvency commencement date. So the date is also mentioned between a willing buyer and a willing seller. So here they are also clear that it is a willing buyer and a willing seller in an arm's length transaction after proper marketing and the way the parties have acted knowledgeably, prudently, and without compulsion. So they are saying that a proper marketing is taking place. There is no compulsion to sell. So this is more nearer to the definition in NDS rather than the definition in the old accounting standards or the Income Tax Act. But the key difference is that the Indian accounting standard talks about an exit value, selling price. Here they are talking about realizable value. Then there could be certain transactions where or where the assignment is for valuation based on certain particular valuation basis, say the participant specific value or liquidation value. So ICA valuation standard defines the participant specific value as participant specific value is the estimated value of an asset or liability, considering specific advantages or disadvantages of either the owner or identified acquirer or identified participant. So basically, we consider synergies over here. What are the synergies that a party will have or has on account of the use of the current of the asset? And the liquidation value is basically the amount that will be realized on sale of an asset or group of assets when an actual hypothetical termination of the business is contemplated, assumed. So this is, of course, used mostly in IBC cases, or if in a certain circumstance the client may request for it. But mostly what we use is fair value or fair market value. So any questions at this stage?
Yes, sir.
Yeah.
Can the valuation be made on restricted usage of trademark for a particular territory or region?
That depends upon first is where all the trademark is registered, whether it is registered in one territory or whether it is registered in more than one territory.
Okay.
So if the trademark is registered only in one territory, then of course the valuation will have to be restricted to the activities relating to the trademark in that territory only. But
Right.
nowadays the Trademarks Act and also the other laws allow a company to register the trademark in various jurisdictions.
Okay.
So that is allowed. So that depends upon whether the company has obtained that registration or not.
Okay.
And and then also it depends upon the purpose of the valuation. What is the purpose of the valuation? Why does the party want that valuation? So if there is a very specific purpose for which the party wants the valuation, then perhaps it can be restricted to a particular territory, depending upon the purpose.
Okay. The next question, is it mandatory for a trademark to be registered for doing the valuation?
No, it is not necessary, but the valuation will be significantly lower if it is not registered, because the point is that anybody else can copy the trademark and it can significantly affect the business because of increased competition.
Okay.
So normally what happens is that when we are valuing a trademark or a brand which is not registered, we would then take a significantly higher discount rate, or factor that into a lower, say, lower revenues or lower cash flows.
Okay.
Yeah.
Will the valuation of trademark differ if it is registered as TM or R?
No, TM is only where it is applied for. R is when the registration has actually taken place, because the registration process is quite long actually. So it takes a while before the registration happens. There is a fairly long process for registration. So when once the company has applied for the registration, they can use the TM, and then the valuer can assume that the company, that if depending on facts and circumstances of the case, that the company will get the registration. There should not be any circumstances which will prevent the registration.
Okay.
Yeah. But of course, the valuer should see whatever the correspondence that the client has had with the registrar of trademarks.
Okay, the next question, we can go to the next question. Is it must to register the MNC trademark in India?
Yeah, as I mentioned, that so either you register it in India, or there is a concept of a thing where the trademark gets registered in multiple territories together.
Okay.
So either the MNC can do that or get it registered in multiple territories together, or otherwise they will have to get it done in separate territories.
Okay. The next question is, in IBC, under which category trademark comes?
So trademark it will come under securities and financial assets.
Okay.
because it definitely does not fall under land and building or plant and machinery.
Yes. So these were the questions. So we can continue the session.
Okay.
Thank you, sir.
So coming back to the valuation approaches, now we come to what are the three approaches. As usual, for everything else also, we have three approaches for valuation of trademarks and other intangible assets: cost approach, market approach, income approach. So let's look at them. Cost approach is a valuation that reflects the amount that would be required currently to replace the service capacity of an asset, often referred to as the current replacement cost. Cost can be used where cost can be estimated reliably. So this is an important factor, whether we can reliably estimate the cost. Replacement cost, so it has two methods: replacement cost method and reproduction cost method. Replacement cost method is where you can recreate an asset of substantially the same utility. It need not be the same asset, but an asset having the same utility, and a buyer, basically with the premise that the buyer will not pay for more for an asset than the amount necessary to replace the asset, and we have to make adjustments for wear, tear, and obsolescence. So basically, we commit the depreciated replacement cost. And reproduction cost is where we create a replica of the asset. So normally, reproduction cost is not applicable for intangibles at all. Hmm. And a replacement cost can be, but the problem with it is that it's very difficult to identify the costs, particularly for items like intangible assets, like trademarks, because it can only be used for the initial stages of the trademark expenses, such as designing the trademark and registration of the trademark. Because subsequently, when the trademark is put into use and the company starts to make sales, it becomes difficult to segregate the costs incurred between, especially the advertising, marketing, selling, marketing costs, between what is the cost for brand building and what is the cost for maintaining and growing the sales. So it is practically not possible, and therefore, virtually following the cost approach becomes very difficult. And it is also impossible to create a trademark with the same utility or a replica of the existing trademark. Now, for example, if I take Surf, Surf is a big brand of Hindustan Unilever, and they can't, they or anybody else today cannot create a brand which will have the same recall value as Surf, or which will have the same amount of sales as Surf. It will take years and years and years. So, so it is practically difficult. So normally, cost approach is not used. Then coming to market approach. Market approach is a valuation approach that uses prices and other relevant information generated by market transactions involving identical or comparable, that is similar assets, liabilities, or a group of assets and liabilities, such as a business. So there are two methods, as we all know: market price method, which is the guideline price method, or the comparable transactions method, which is the guideline transactions method. Now, coming to the market price method, basically we look at what is the market price of a same asset in the principal or most advantageous market, and we look at the prices in the orderly transactions and freely traded markets. The problem is that this method does not apply to intangible assets, because intangible assets don't have a market where they are freely traded. Now, there are only very few transactions. So this method does not apply normally. Then coming to comparable transactions method. So IVS 210 states that guideline transactions method is generally the only market approach that can be applied to intangible assets. The recent sale price of a same or a similar asset in an arm's length transaction and the relevant transaction multiple, or the market price for the license of the same or a similar asset to an independent third party. So these two things you can use, look at the transaction price or the transaction multiple, or the what is the license. So whatever is the royalty rate or whatever, you can look at those things to arrive at the value. However, the important point here is that we have to make sure that such transactions are in the same industry sector, same industry or sector. The date of transaction is close to the valuation date. The size of transaction is similar. For example, if you're talking about a sale of a trademark or a brand, the size of that brand and the size of the brand that is being valued is similar. It can't be too different. and geography where the trademark is used, market size, etc. So a trademark which is sold in the USA cannot have the same multiples for a trademark which is being used in India. So we have to consider things like that also. So IVS Putin states that the heterogeneous nature of intangible assets and the fact that intangible assets seldom transact separately from other assets means that it is rarely possible to find market evidence of transactions involving identical assets. So therefore, IVS is also saying that it is very, very difficult to apply the market approach. Normally, what happens is that the trademarks or brands are sold along with the business as a whole. They are rarely sold separately. There are examples which happen where a brand, a trademark can be sold separately, but there are not too many. If there is a market evidence at all, it is usually in respect of assets that are similar but not identical. So it becomes so. Even if you find an example, you will have to make significant adjustments to arrive at a valuation of the trademark being valued. So as I said, there are very few examples. One of the recent examples where only the trademark was acquired is Reliance Retail's acquisition of Campa-Cola brand in 2022 for 22 crore rupees. So they've just acquired the brand. And as I mentioned, it's very difficult to find transactions of a comparable trademark. So, and most cases involve sale of trademark as well as associated business. So in the newspapers, you will see there are a lot of news about that X company has acquired the brand of a following of a Y company, So, but when they talk about a brand being acquired, it is not just the brand; it is the underlying business also. So I have just given you a few examples here. There are lots of examples available. Imami's acquisition of Kesh King Hair Oil business in 2015, Edam House of Brands acquisition of Bevzilla in 2020, Reliance Retail's acquisition of Amante brand in 2021, Cipla's acquisition of Vysov and Vysov M brands from Novartis in 2019. So all these are while the brand is being acquired, but the underlying business has also been acquired. So we don't have a value which relates only to the brand. And therefore, it becomes very difficult to value the brands or trademarks on market approach basis. Now, the only approach which can be used most of the time is the income approach. It is a valuation approach that converts maintainable or future amounts, that is the cash flows or income and expenses, to a single current discounted or capitalized amount. The fair value measurement is determined on the basis of the value indicated by current market expectations about those future amounts. So we do a projection there is a financial projection of revenues, income, expenditure, and then we do a present value discounting to arrive at what should be the value today or on the valuation date. So the methods that are common for trademark valuations are relief from royalty method. This is the most common method and the easiest, relatively the easiest method to use. With or without method, which is also called the incremental value method, multi-period excess earnings method, differential of price to sales ratio method, and price premium method. There are a couple of other methods also, but these are the ones that you will hear about mostly or read about mostly. So we will go into these in greater detail. So a key thing about so before going into these particular methods, a few aspects to be kept into mind while following the income approach. First is that the cash flows and discount rates should reflect assumptions that the market participants would use in pricing the asset. So it is not just the seller. So seller could have a particular set of assumptions, but and it may consider its own and seller's own or the party whom asset we are valuing their own synergies and other factors. But we have to see that if the asset were to be sold, how can the other parties use that asset and what kind of revenues will they generate and what kind of benefits they will get. Only factors attributable to asset being valued should be considered, including timing of cash flows. So we don't have to consider other assets and other items. And, and a most important fact, we have to see the reasonableness of cash flows. So we have to evaluate that. A significant factor is whether a trademark or a brand is registered or not. And unregistered trademark has no legal protection, as I was mentioning earlier, and hence a significantly higher discount rate should be applied. This is because somebody else can easily copy the trademark and start, and therefore it will lead to significantly higher competition. And there is no legal protection available. One cannot go to the court and fight against that other party. So I will give you one example here. So in Delhi and North India, there is a very famous brand called Caventer's for milkshakes. And then one of the other party, one of the franchisees or somebody else has started using a similar sort of a brand hmm, with a minor modification. It's basically the one says Caventer's, the other one says Caventer. Uh, and if you go to the websites, which I've mentioned the websites here also, and both of them talk about the same origin, the same person who started the brand, and they give the exactly the same history. So obviously, the original party, whoever it is, would be suffering because the other parties now have copied it and they are sort of eating into their business. So the other factors that we should consider is factors such as growth stage, stable stage, or decline stage of the business actually, and how it affects the trademark and the effect of competition. So depending on whether the competition is expected to grow or not, uh, what kind of industry it is, how will it affect, is it easy for the competition to, what are the barriers to entry, things like that need to be considered while looking at the reasonableness of the cash flows. And assumptions for cash flows and discount rates should be internally consistent. Example is inflation. For example, if we are considering projections which include future inflation, basically nominal cash flows, then our discount rate should also be nominal. Hmm. So we have to, and if we make projections which are excluding the inflation, then our discount rate should also exclude the inflation. So we have to be consistent on both the sides. And the starting point is the risk-free rate of requisite maturity or duration. Discount rate should be consistent with underlying economic factors of the currency in which the cash flows are denominated. So if the cash flows are in rupees, our discount rate should be based on the interest rates in rupees. If the cash flows are in US dollars, then we should consider for the discount rate based on factors in US dollars, considering the US Treasury rates and the exchange and the stock market premium in the USA, things like that. So it depends upon, basically, we have to bring consistency between the projections and the denominator, which is the discount rate. Generally, an intangible asset carries more risk than other assets, a group of assets or a business as a whole. So basically, what I'm trying to say is that because it carries more risk, it should have a higher discount rate. Intangible assets having longer economic useful life have higher risk than assets with a lower useful life. So like a brand, because a brand can have a very long useful life, as I mentioned, that it can be renewed from time to time and it can go on till infinity. So the risks, because we cannot look into the future for too long, therefore it can have higher risks. And also, uh, intangible assets are less liquid compared to other tangible assets or a business. It's not easy to sell a pure intangible asset or a pure trademark as it is compared to selling a business as a whole. Hmm. So, so there is less liquidity, and therefore discount rate needs to take into account that fact also. So a discount rate needs to be slightly higher because of that fact. It's like a DLOM, discount for lack of marketability, except that we don't do a separate DLOM adjustment in valuation of intangibles. We do it by way of increasing the discount rate. Then what adjustments should be made for discount rate? One is for default and systematic risk. Default risks are risk relating to business, and systematic risk is risk relating to the whole market or economy, including risk inherent in the asset and the risk of achieving the cash flows. Then, so you can either have regular cash flows and make this discounted, or you can adjust the cash flows, probability of different cash flows plus systematic risk. So you can do a probability weighted cash flow, and then use that cash flow. In which case you can use a normal sort of a discount rate, or you can have a risk adjusted cash flows where you just consider what are the possibilities of cash flows, different types of cash flows happening versus that business, but not considering systematic risk. So not considering risks relating to the market or risk relating to the economy. And then use a discount rate, which sort of takes into account a rate that the market participants will require. For example, a rate based on CAPM. CAPM is, as you all know, capital asset pricing model. So arrive at a weighted average cost of capital. So it depends upon how you calculate what cash flows you consider. Your discount rate has to reflect, has to be made or computed accordingly. So I can take some questions here before I go forward into various methods.
Yes, sir. 1 second. There are a few questions, sir.
Yeah.
In India's para 113 and 117 speak about HABU. IBC talks about fair value being exit price. Under IBC, we follow HABU or exit.
So IBC talks about realizable value in an orderly transaction between market participants, between willing buyers and willing sellers, with proper marketing. So it does not necessarily mean HABU under IBC. But the problem that arises is that when we are doing valuation under IBC, we also have to follow valuation standards. Whether we are following ICI valuation standards or we are following international valuation standards. The standards talk about HABU for non-financial assets. So we will have to consider HABU because otherwise we will not be complying with the standards.
Next question is how we can take fair value from external confirmations.
So can somebody explain what do they mean by external confirmations? The person who raised this question, can they? Because I'm not very clear. Well, we can have market transactions. Yeah.
Yes. So I'll request him to put the questions again. So once I receive later, so we can.
Okay. Yeah.
How to value trademark in CIRP if no documents available?
If no documents available, well, one will have to see what are the past financials, which if you can get them from, if the company is not able to get them, you can get them from ROC, from MCA website or from databases. Look at what is happening in the industry, industry information you can get. And based on that, you can sort of draw up some projections and do a valuation.
How valuations will be accounted?
Of course, you will have to give appropriate disclaimers.
Yeah, disclaimers is required. Right?
Caveats and disclaimers will have to be given. Yeah.
How valuations will be accounted for when more than valuations available? Is it actual transaction valuable, realizable valuable, market value, or buyer?
No. Can you please repeat that question? I didn't understand the question.
No, yeah, I think it's something is missing here, so I'm also not able to. Yeah, we can move to the next question. Is trademark if trademark is registered in India, it has impact in international market?
No, a trademark registered in India will not have an impact in international market because it will not be recognized anywhere else. So there is, as I mentioned earlier, the Trademarks Act actually allows for a multi-territory registration.
Right.
So a company can go and get a trademark registered in various countries. So, so
Is
that
it-
can happen. Yeah,
Yeah.
but otherwise, if it is registered only for India, it is valid only in India.
Is the valuation approach different in case of software? If yes, how do you value this? Software.
No, so software can actually be valued even under cost approach.
Okay.
Because software, one can actually, of course, you need some technical help there. Uh, because there actually somebody can actually go and estimate how many hours it will take to develop a similar software, and what are the market rates that are paid to, say, software engineers and others. What kind of salaries are paid currently on that valuation date, and based on that, one can come up to cost of the software today. Hmm. And and then you add overheads or a profit margin to it and come up to a cost today. So that can be done. And if, of course, if there are similarly traded software in the market, then you can consider market approach also. And income approach is available. Again, it depends upon uh, how important is that software vis-a-vis that particular business. So that will, because then it will depend upon what kind of approach we can apply, or what rather what kind of method we can apply. And various softwares, they have licensing arrangements also. For example, if you take ERPs and things like that, so you can take what are the pricing of those and use those pricing as a benchmark.
Okay.
So for software, there are various options available, but I think some technical help is needed over there. We can't. It will be very difficult for us as chartered accountants or registered valuers to do it on our own.
Okay. Sir, is patent also valued in the same way as trademark is done?
Yeah, similar way. Yes.
Similar.
Of course, there are some differences because it is similar to trademark because similar way.
Okay. Okay.
Hmm.
Thank you, sir. And now we
Yeah.
can continue with the session. Yeah.
Okay. Yeah. So let's first come to relief from royalty method. As I mentioned earlier, it is the most common method used for valuation of trademarks, and it is also the simplest. And so it's relatively easy to do. And items which can be licensed and a royalty earned from them. And for our purposes, for valuation purposes, we say which is royalty saved due to owning the asset rather than licensing them. So trademark, brand, patents, technology, software, it can be applied to relief from royalty method can be applied to all these. Intangible asset. So the concept behind it is that the intangible asset has a fair value based on royalty income attributable to it. Royalty income represents, so from the perspective of the owner of the brand or the trademark, royalty income represents the cost savings of the owner of the asset. The owner does not have to pay the royalties to third parties for license to use the intangible asset. So the owner is saving these royalties. And therefore, the present value of those savings is the valuation of the brand. That is the concept here. The derivation of royalty income comprises of two steps: the determination of revenue attributable to the asset and the determination of the appropriate royalty rate. So first we will determine what is the sales, what is the revenue that is attributable, that is arising from this trademark. So if I were to simply go back and take the example of Surf Excel, as I was mentioning earlier, so what is the sales of Surf Excel and what are the projected sales of Surf Excel? So we take that and then we see what should be the royalty rate for that. And then we do the discount the present value of that royalty income stream, not the sales value, but the royalty income stream is discounted to present value. And then we add a tax amortization benefit to arrive at the final value.
So let them go. They'll go in chaddi. You will also go in chaddi.
Someone who goes for pajamas. If somebody can be on mute, please. Yeah. Okay, so going ahead, the determination of revenue attributable to the asset should be based on assumptions expected to be made by the market participants. Again, the synergies that the owner has should normally not be considered. Unless we are doing the participant specific valuation, if for a fair value valuation, we will only consider what the potential buyers of the trademark, the assumptions they will, how they can use the asset and what kind of sales they can make. So we will consider that. And we have to also consider what kind of market participants will be willing to buy the asset. So it could be strategic acquirers or competitors, or it could be nowadays even private equity funds buy businesses and run them. So it could be private equity funds. So one has to see what kind of industry it is, what kind of players are there, what kind of people are doing that M&A transactions in those markets, in those businesses, industries, and then consider what kind of from their perspective, what kind of sales can take place. Then another fact is that, when you have a trademark, you also have to incur certain trademark maintenance expenditure, which is a part of your overall advertising, selling, and marketing expense. Well, it's not separately incurred, because when you incur advertising, selling, and marketing expenditure, that is also helping you maintain your brand or sometimes even grow your brand. So you are incurring that expenditure. Uh, so the standard says uh, that, in fact, IVS says that the first paragraph is actually coming from IVS, which says that you have to see when we are trying to use the method or whatever method, when we are arriving at the royalty rate, what kind of a royalty rate it is. Is it a gross royalty rate or a net royalty rate? Gross royalty rate is where the licensee will pay a higher royalty, but will not incur any advertising and marketing expenditure to build the brand. And a net royalty rate is where the licensee will pay a lower royalty, but will also incur advertising and selling expenditure. So one has to see what kind of royalty rates are available to us. And basis that, we will have to see whether we need to deduct marketing, training, trademark maintenance expenditure to arrive at the final cash flows. So this example has also been given in, there is a toolkit issued by the Appraisal Foundation USA, and it is available on the website. You type this and you will get it. And there they've given an example of how to consider this. And in fact, even para 58 of ICA valuation standard also talks about it, that associated costs to be incurred by a licensee to be reduced from forecasted revenues. So it is included in IVS, it is included in this toolkit. Toolkit actually has an example. And uh, it is also there in ICI valuation standard. However, in my own personal experience, whenever I have done some valuations of trademarks, I have most of the examples that I have, or most of the royalty rates that I have found are on the basis of gross. So I have not had to reduce any maintenance expenditure in those cases. So, but one has to look at that fact and see. In fact, I have seen certain reports of other firms. And in fact, Big Four firms, I have seen those reports where they have actually considered trademark maintenance expenditure as a deduction from the royalty income to arrive at the final cash flow. And so, how do we arrive at the royalty rate? Because this is the most. So, first is determining what should be the revenue, and the second step is determining the royalty rate, because we have to ultimately arrive at a royalty income stream. So, we have three methods available. One is market comparable royalty method, one is return on asset method, and one is excess operating profit method. Market comparable royalty method is basically what is the kind of royalty being paid on other transactions. So normally we get this from there are various paid databases available. I normally use the first two, royaltysource.com or ipsio.com, and there are various others. I have mentioned a few, but there are far more. And not in India so much, but abroad, even annual reports of companies or filings with, say, US SEC or published books and articles can also have sometimes royalty rates available, which can be used. As I mentioned, these are paid databases. So normally what they do is that once you put in your search, and they will say after a day or so, they will send you a link which will give you a summary of various transactions that have happened. And then from those summaries, one can find out which are the ones which relate to your particular situation. Same industry, same business, same type of products. Hmm. So you do that, and then you can select them, those particular ones, and ask for a detailed report. The summaries don't give royalty rates. So you ask for a detailed report, and then you have to pay for that detailed report. So normally they charge for a minimum of 10 items. Well, whether you take two or whether you take 10, you have to pay the same amount. And then if you are taking more, then you have to pay more. So normally $350 to $400 is the minimum expenditure. So normally when I do this assignments, I ask the client to reimburse this cost to me separately. And so I take royalty rates from there and then go about doing my work. Then the methods, as I mentioned, are return on assets method and excess operating profit method. So let us look at these. Now, what are the factors that we look at? One is competitive environment, the size of the market for the intangible asset. So how big is the industry, whether the industry is growing or not, whether new competitors are coming in, barriers to entry, things like that we have to see. And how is it for the customer to buy, instead of buying Surf Excel, whether they will buy another brand, or or say credit detergent or something else, whether or is it the quality of the product or whatever. So various factors need to be considered to see what kind of, whether it should be a higher royalty rate or a lower royalty rate. Importance of the subject intangible to the owner, whether the subject asset is a key factor of differentiation from the competitors. The importance it plays in the owner's marketing strategy, its relative importance compared with other tangible and intangible assets, the amount the owner spends on creation, upkeep, and improvement of the subject asset. So the last one is that I was talking about, advertising and marketing expenditure. And the lifestyle of the subject intangible, the expected economic life of the subject asset and any risks. So again, here we look at what kind of a business it is. Is it a growing business? Is it a stable business? Is it a declining business? As you know, the 70s or 80s, we used to have so many brands which are no longer there today. So that is because either new products have come into the market or new brands have come into the market. Say, if I talk about electronics, we used to have a brand called Western, we used to have a brand called Televista, we used to have a brand called Onida, and we rarely listen to them or hear about them now. I don't know whether they exist or not. Similarly, in refrigerators, we used to have a brand called BPL. At least in North India, I don't hear about it. So things like that. So brands can sort of wither away also. So we need to look at, and sometimes the acquirers will deliberately kill a brand also. So we have to look at those factors and then see what kind of royalty rates to apply. And then also the additional criteria is that when we are looking at, say, databases, we have to see whether the same type of products and services within the same general industry or market. Similarity in regard to uniqueness of the asset, expected life, and government protection. So again, we have to see that if we are looking at databases and we find transactions in other countries, again, whether they are registered trademarks or not, and what does the law say about registered trademarks in those countries. So we have to look at that. And government protection depends upon whether trademark is registered or unregistered and whether registration is applied for. Also, different jurisdictions may offer different level of protection. So we need to look at that aspect also, particularly if you are doing evaluations for brands which are outside India, or we are looking at data, royalty rates data, which is from outside India. Then coming to return on assets method, royalty rate is estimated by subtracting the expected return of assets on tangible assets, fixed assets, working capital, other assets, and other intangible assets which are already valued or recorded from the overall return achieved by the business. So, for example, a business may be earning a return of 20%, and then we will sort of see what is the expected return that fixed assets will earn, what is the expected return that working capital will earn, what other assets will earn, other intangible assets will earn. And say we say that fixed assets will earn a return of 10%, working capital will earn a return of 12%, other intangible assets will earn a return of say 22%. And we come to an overall weighted average return based on these items to say 16%. So 20% minus 16%, the 4% will be the royalty rate that can be applied. However, we also need to see that the company may have other unidentified intangible assets or other unrecorded intangible assets, and that 4% also includes a return for those items. So we will have to make an estimated deduction for those. So 4 may ultimately 4% may become 2%, but this becomes highly subjective. So the problem in this method is that it is a very, very highly subjective method. And similarly, the excess operating profit method. So you compare the profits of companies having trademarks and with those not having trademarks or having inferior trademarks, with very little sales or whatever. So you get this data either from stock exchange websites or from databases like Capitaline or MCA website. Also, you take this data and you compare the profitability. Generally, the user of trademarks would have a higher return compared to a business which does not have a trademark. So such excess profit then can be considered as a rate of percentage of sales for the purposes of coming to a royalty rate. However, we also need to see that one is that those other companies that we are looking at which do not have a trademark, they may have some other intellectual properties. And therefore, there may be some profit element relating to that intellectual property also. So this will lead to a royalty rate becoming higher. And also we need to consider what kind of business, because there are certain businesses or industries which have low profitability, and there are certain businesses which have higher profitability. So lower profitability businesses will always have a lower royalty rate, and a higher profitability businesses can have a higher profitability rate. So we need to consider those aspects also. So basically here we are looking at industry as a whole. We are not looking at particular companies, but we are looking at industry as a whole. And as I mentioned, we can get this information from either stock exchange websites or databases like Capitaline or other databases or MCA websites. So, and I think even nowadays we have these databases like Valutico and all, which can also give such information. So this is an example of relief from royalty method. So as you can see, I have plotted the product sales here. So considered assuming that this company the brand can continue into perpetuity. And anyway, beyond a period of 25, 30 years, the discounting factor becomes almost zero. So considering that, and here the royalty rate has been taken as 2%. So arriving at a royalty income stream, and this is a net rate, not a gross rate. So there is no need to deduct maintenance expenditure here. Then we apply the tax, because there will be a tax saving if the company is not paying royalty. Therefore, they are incurring more tax. So royalty income we have to consider net of tax. So we consider net of tax royalty income, then use appropriate discount rate and come to a present value. And then we add to that present value that we arrive at In this case, for the projection period, it is 420. For perpetuity, it is 547. Total is 967. And then we add the tax amortization benefit to it. And then the final value comes to 1056 in this case. So, so it is a fairly simple method. Not there are no complicated calculations. Straightforward. The only important thing here is determination of the royalty rate. Then talking about tax amortization. Okay, so this is the data that I had taken. This is I've taken from an actual assignment of mine with minor adjustments. And this is the data that I had taken from ipsio.com for my assignment. It was a technology company. And I have actually included this in my report as to these are the royalty rates, transactions that I have considered. And I got um, a range of 1 to 3%. The median rate came to 2%. So I took 2% as the rate for my valuation here. Now coming to tax amortization benefit. Now the important thing is that whenever we apply income approach, we have to consider tax amortization benefit, because that is the benefit we say an owner of the asset will come. If the asset was appearing in the balance sheet, then the owner will get the amortization under income tax, and that the benefit of that income tax of the reduced taxation will be available to the person. Therefore, it is considered in while arriving at the valuation and the income approach. It is not considered in cost approach or market approach, because those prices or those values already include the tax benefit in. Because when we buy, say, an asset from the market, we just take it at the same price into the books. We don't add a tax amortization benefit on top of it, because it is already included in the price that we are paying. So it is the present value of benefit, that is a tax shield, that is an intangible asset holder would get by claiming amortization on the value of asset for income tax purposes. The discount rate should be the same as used for valuing the intangible asset. Alternatively, WACC can be used. Normally, as I mentioned, that intangible assets or the trademark, etc., would have a higher rate than WACC, because they are more risky, they are less liquid. However, the valuation standards, both IVS and ICA valuation standards, allow us to use either the discount rate for intangible assets or WACC for computing the present value of tab. So they allow us both. So it is up to the valuer to choose either of the two. For this purposes, amortization rate and tax rate of concerned jurisdiction should be considered. So if the trademark is registered in India, and it depends upon where the company is able to claim the tax benefit. So if the company is, say, is in India and it claims tax benefit in India, so we will take what is the amortization rate applicable under Section 32 of the Income Tax Act, and what is the tax rate applicable to that company, whether it is 15% or 22% or 25% or 30%, as the case may be, and take that rate, and basis that we will calculate the tax amortization benefit. So normally, say, particularly in an acquisition scenario, when there is an acquisition and a company has, the target company has subsidiaries in foreign locations, for say in UK or USA, and they have brands registered under those subsidiaries or trademarks registered under those subsidiaries, and those subsidiaries are able to claim amortization of those brands, will be able to. So had the asset been appearing in the balance sheet, then those subsidiaries would have been able to claim the amortization. So we have to consider the amortization rates and tax rates of those jurisdictions, whether it is USA or UK or whatever, not India. So this is an important point to be considered. So, and also for in a merger and acquisition cases, it becomes important because particularly under Ind AS or IFRS, we have to create a deferred tax between the difference between fair value of the assets and income tax value. Huh. So, the tab helps to balance it out a little bit. Now I have given below the table which sort of shows the computation of tab. So I have taken what is the value of the asset, say starting with rupee 1, and this is just to calculate the factor. So rupee 1 and how much depreciation I will get each year, and applying a discount factor to it. And here I use the same discount factor as the one that I have used for the valuation of the trademark. And then I have taken the tax rate, and based on the discount factor and the tax rate, I am getting a benefit of 0.08. Then this is basically 1 upon that. So I am getting the step up factor of 1.09. So which means that my benefit is 9%. So my net benefit is 9%. So that 9% is coming here. If you see, tax amortization benefit is 89, which is 9% of 967. So this sort of completes the relief from royalty method, and I can take some questions if any over here.
Yes, sir. I request all the participants to fill the feedback form as link is shown on their webcast screen. So coming to the questions,
Yep.
how the registered name will help the person who registered, how long will be valid and renewal process?
Okay, so the renewal process is that, well, it's an application to be filed with the registrar of trademarks, and you have to pay a fees. And so normally it is, and it has to be done, I think, before the previous registration ends, or if it is allowed even within 6 months after the end of the registration. And so it's a routine process. Renewal process is fairly routine. And but how it helps the party who gets the registration done is that it enables them, then any other party cannot use the same brand or same mark or logo or whatever, same name. So it prevents other parties from using it. And if some other party does use it or copies it, then the registered owner can go to the court and get a injunction against it, or can claim for damages from the other party. That is the benefit. So there is an exclusive right available to the owner to use the benefit, the trademark.
The next question is
Was there anything else in the question?
it is how long it will be valid and the renewal process.
So validity period is 10 years, and then it can be renewed from time to time.
Okay.
So every time it can be renewed for 10 years.
10 years. So it is always 10 years, sir?
Yeah, 10 plus 10 plus 10 plus 10, it can go on. Yeah.
Will the development improvements improvisation cost of a purchased trademark be considered for valuation?
No, because it is very difficult if you go by the standards, basically both under the accounting standard, which is AS 26 and Ind AS 38. They do not meet the criteria for capitalization. So even so, basically, and also as I mentioned, that it is very difficult to segregate the cost for promoting the sales or maintaining the sales and for brand building. It is very difficult to, if you incur 100 rupees, how can one say 50 rupees is for brand building and 50 rupees is for promoting the sales? It is very difficult to say that. So normally it is not allowed. Yeah.
What are the parameters used to assess the size of trademarks and compare?
Basically, you look at, most commonly you look at revenue.
Okay.
So as I mentioned, say if I was to take the example of detergents, and if I were to value Surf Excel, I will look at what is the revenue of Surf Excel, and I would like to look at similar transactions or royalty rates of other businesses having a similar size business.
Okay.
Yeah. So revenue is the most common denominator here.
Okay. How to get conclusive evidence that there is no other brand with same similar name in the market? How to substantiate the discount rate?
No, substantiating the discount rate, for as far as substantiating the discount rate is concerned, we always start with WAC. WAC is the first thing, weighted average cost of capital of the company. So you have to start with that. And then, uh, to some extent, it is up to the valuer how much additional premium to add, depending on, again, how big the brand is, how popular it is, what are its competitors, what kind of profitability, overall profitability the company has or that brand has. You look at those kind of things. So if there is higher competition, if there is lower profitability, you will take a higher discount rate. If there is less competition, higher profitability, things like that, you will take a lower discount rate. So there is no hard and fast rule. So it depends upon valuer's opinion. Well, there is no fixed formula. And what was the other part? There were two parts, no?
No, how to substantiate the discount rate?
Which is what I've just mentioned.
Yeah, yes. How to value trademark of startup as there are no similar transaction available?
Yeah, so basically you will only do it by way of income approach.
Okay.
So you will have to look for, mostly you will have to go through these paid databases to find royalty rates for similar companies. And then do it.
Coming to next.
Market approach and so cost approach, even if you apply the cost approach will only be basically the cost of designing the trademark and cost of registering the trademark, which will be a very small amount.
Okay.
Yeah.
Coming to next question, how to do valuation for trademark for pharma company which does not have identifiable cash flow?
If somebody can explain further to me as to when they say they don't have identifiable cash flow, what does it mean? Is it an R&D company or what? I'm not clear.
We will wait for the question from the participant. What is depreciated replacement cost at the time of arriving at liquidation value? I think this is not.
No, so normally, okay, so this is not necessarily a question related to trademarks or intangibles, but basically, I think the starting point for arriving at a liquidation value for tangible assets, particularly tangible or intangible assets, is that you first calculate the depreciation replacement cost for land, building, plant and machinery or other items. And then you apply a factor as to what is the loss that will happen on liquidation. Because liquidation means that you are closing down the business and selling. So you will not realize the same value as one would realize in a going concern. So there is a loss because of that. So there is a factor to be applied for that. So you first calculate depreciated replacement cost and then apply this factor.
Okay. Yes, sir. Now,
Or for intangibles, there may not be a depreciated replacement cost. There may be a straight away you calculate value using income approach or market approach and then consider a higher discount rate.
okay, sir. We can now continue with the session.
Okay.
Yeah, thank you.
Okay, then coming to incremental cash flow method. So this is also called a with or without method. So basically here, this is applicable for non-competition agreements, customer contracts, customer relationships, brands, technology, leases, purchase contracts, debt. So various types of items, this method can be used. And it is normally used for substantial assets, more important assets of a business. So, say in a particular case where a trademark or a brand is not so important compared to other things. For example, a patent may be more important than a trademark. So their incremental cash flow method may not be the most appropriate method to do the valuation of a trademark. So it depends upon the relationship of various assets. Huh. But where we say that a trademark is very important, there we can apply this method. Say in an FMCG type of company, or so there this method may be applied. And mostly where it is like a single product company. So it basically compares the cash flows in two scenarios. One scenario where there is the trademark available. Second scenario that the trademark is not available. There is no trademark. So we calculate what would be the sales and expenses and profitability where the trademark is available, and secondly, what would be the sales and expenses and profitability where there will be no trademark, and then calculate the cash flows, and then we discount both of them to present value, and the difference between the two is what we consider as the value attributable to the asset or to the trademark, and then we add tax. We then add tax amortization benefit to come to the final value. So it is with the trade. When we say with or without method, we say with the asset, with the trademark, without the asset, without the trademark, and calculate the cash flows in the both scenarios. Take the do the present value discounting. In both cases, we will use the same discount rate. We will use for both with scenario and without scenario, we will use the same discount rate. We do the present value discounting. The difference between the two is the value that we get. Then we add tax amortization benefit, and then we come to the final value as the value of the asset. So let us look at this table here. This is an example again. So sum of present value of cash flows with the trademark 23,702. Sum of present value of cash flows without the trademark 13,172. So cash flows. No, okay. So the language is wrong. So this is the benefit arising because of the trademark. So 10,530 is the benefit arising out of trademark. And then we get a tax. As I mentioned, we had previously calculated 9% as the tax amortization benefit. So same percentage is applied here. And we get the fair value as 11,497. Now, these are the cash flow. This is the normal DCF. This is absolutely a normal DCF. One with the trademark. So normal DCF, one with the trademark. This is with the trademark. And this is without the trademark. So, of course, there are underlying assumptions. There are various underlying assumptions of, first of all, of course, with the trademark, and then without the trademark, how much will be the loss in sales, how much customers will get lost, how will it impact the expenses, whether the company will have to incur more advertising and selling expenses. Things like that have to be considered. So all that has to be considered, and so how will it impact capital expenditure? How will it impact change in working capital? So all these things have to be considered to arrive at the cash flow without the asset income. So we arrive at the again discounted cash flows here, and as I mentioned, the difference between the two is what we get as the value, and then we add tab, and then we get the final value. So it's a very detailed exercise. Just trying to see how much time I have so that. Then third is multi-period excess learning method. It is also called mean. In short, it is applicable to the most important asset in the business. The methodologies and the valuation standards say it should be applied to the most important asset in the business. So basically, it is used for brands, but less. Mostly, it is used for things like customer contracts, patents, technology. Those are so. But I'm showing you an example here as to how it can be used even for evaluation of brands or tangible or trademarks. So most important assets. So this will be the case, say, for example, in a single product FMCG company where the brand is most important. So, for example, let's take McDonald's. Well, it has various food products, but they are all food products. But But people go to the restaurant only because of the name McDonald's. Everything else comes secondary. So, so there, this technique may be most beneficial technique to be applied. Or for that matter, Coca-Cola or Pepsi, those kind of companies. So calculate. So what we do is that we first calculate what are the income and expenditure of the business as such, of that particular business where the trademark is there. For that business, we will calculate the cash flows, income and expenditure. We will compute, we will apply the taxation, and we will compute the post-tax cash flow. But this is only income, expenditure, and taxation. We don't consider capex, and we don't consider changes in working capital. Those we consider as part of what we call as contributory asset charges. So tangible assets, other intangible assets, working capital. So all of these we consider contributory asset charges for all of these items. And the principle is that instead of the company or the business having owned these assets, what would be the cost if they were leased from third parties? So the leasing price, when we take a finance lease or something similar, what we pay to the third party is a return of the asset. So we are paying a depreciation equivalent, and we are also paying a return on the asset. So we are paying a financing cost. So it is a combination of both the depreciation or amortization plus the financing cost. And the return that we consider, the financing cost that we consider in this case is post-tax. Because earlier, as I mentioned, when we do the cash flow above, income, expenditure, we also minus the tax. So our cash flow above is already post-tax. So here also we are considering a post-tax return on other assets. Then again, we compute what is the final cash flow after deducting the contributory asset charges. I will show you an example. And then again, because it's an income approach, we will also add the tax amortization benefit. So so just to see the table here, starting with present value of excess earnings during the projection period, or it will be during the projection period and the perpetuity if necessary. And then we add tax amortization benefit, again 9%, as I mentioned earlier. In this case, I've actually taken this. This is actually a real life valuation that I've done. I've just done some minor changes to that. So as you see, we have sales, we have projected sales, we have projected expenses. We have depreciation is taken only to compute taxable income. Then we have tax, and then we add back depreciation to arrive at debt-free cash flows to the firm. So we have arrived at cash flows to the firm before any working capital, before any capex, before any other thing. And then we reduce contributory asset charges. Basically, what is the return of and return on other assets? So working capital, plus property, plant and equipment, assembled workforce, even though for accounting purposes we don't count it, but we consider it here because assembled workforce is contributing to the business. They are contributing to further growth in business. They are contributing to increasing sales going forward. So we take a charge for assembled workforce also. And in this particular case was a case of an acquisition. So I was doing a purchase price allocation. So as a part of acquisition, there was a non-competition agreement also. So I've considered non-competition agreement as an intangible asset, and whatever is the amortization of that non-competition agreement is also coming here. And customer relationships. So they had existing customer contracts. So what was the return coming based on those customer contracts? That is also being reduced here. So then we come to the final cash flows, what we call as excess earnings, and then we present value those excess earnings. And based on that, we come to this table where we take the present value of excess earnings, add the tab to come to the final fair value. Now, So for these contributory asset charges, there is a detailed calculation, but just to show you a summary. So we have opening balances. Say if we talk about property, plant, and equipment. So we have this is all IT equipment in this case. So it was a technology company. So the useful life, the client was taking a useful life for 3 years. Have taken a useful life for 3 years. This was a foreign company. So foreign interest rates were quite low. So the return on PPE, the discount rate comes to only 2.34%. And then I've calculated what is the contributory asset charge. So one is uh, opening balance, and second is further capex incurred in future. So for further for the opening balance, it is 3 years only because some life has already gone by. For new, it is 5 years. And then I have calculated. So basically, it is like a leasing cost. So the numbers that I'm considering here is a leasing cost. So comprising both the amortization as well as interest cost or finance cost, whatever you call it. Then working capital. Working capital is basically just the finance cost on working capital. Again, on opening balance and on changes during the period. I have considered mid-period discounting in all the cases. Then assembled workforce. So I've calculated what is the value of assembled workforce and then assumed it will continue for 20 years. And assembled workforce, because we don't consider it as an intangible asset for accounting purposes, we say that the business doesn't have control because people can leave. So here we have considered a slightly higher discount rate. So we've considered, say, 20.25% in this case. Customer relationships, 19.25%. Non-competition agreement, 19.25%. For brand valuation also, I have considered 19.25%. So for the period of how long the customer relationships are expected to last, so say in this case, I'm saying 25 years for whatever reason. So I've considered for 10 years. This table only shows 10 years. So I've shown that. Non-competition agreement is only for 6 years. So I've shown that. So, and this was the transaction happened in mid-year. So this happened on the transaction happened on 31st of May. So therefore, you will see the first column is for 10 months. So this is how we do it. We calculate contributory asset charges, and so these are basically the three most important methods that we use for valuation of intangible assets and trademarks in particular. Then another method for trademarks is differential of price to sale ratios method. So basically, this is the basically if you take the market capitalization of listed companies which have trademarks in the same industry, same business, same products, and compute a price to sales ratio based on the market cap, and then see if there are listed companies without having trademarks or having inferior trademarks, very small sales or whatever. And the difference of ratios between the two will give you the multiplied by the sales will give you the trademark value. Because we can say, well, normally it can be said that the difference is arising only because of the trademark. However, this is not accurate as it does not factor in other price factors that may affect the share price. For example, a company may be a multinational company, or a company may be a part of a big big industrial group, or the corporate governance matters. There are, various other factors. We know that every day there are so many factors which affect the market prices. So, so, so this may not give us an accurate, but one can use it for a ballpark number, as a test or a ballpark number. But normally, this will not give us a more accurate valuation. So I don't have an example for this because I've never used it myself. Then a price premium method. So the price premium method is that this is the assumption here that the branded products will have a higher price compared to unbranded products. So we take the difference between the price of the branded product and the price of the unbranded product. So, and this we will do it for the not for the particular company only, but for the industry, for uh, four, five, six, at least four, five, six companies. You take an average, and based on that, you do it. Then, for the company whose trademark you are valuing, the difference in the price into the quantity of products sold will give you the value of the trademark. Very simple methodology, very simple method. But again, it doesn't. It is not accurate because it does not consider the factors that go into the pricing of the products. It could be the quality of service, quality of product, cost of manufacturer. Multinationals will always have, or large companies will always have a higher cost of manufacturer. Their quality controls are better. Their safety precautions, ESG, various factors come into play. So all those will affect the cost, they will affect the pricing. So it's not only just the trademark which will affect the pricing of the products. So again, it is not accurate. So I have never used this method myself. But I just wanted to tell you that these methods are also available. You can use them as a ballpark, but they will not really give you a value which you can sort of defend. So again, no, this is when we do an acquisition, in case of an acquisition, we do what is called a purchase price allocation. So whatever price is paid by the acquirer to acquire the business, we will allocate that price into all the assets and liabilities based on the fair values. So this is just showing you an allocation here of how we did it. So you see here, I have a brand, I have orders in hand, I have contractual customer relationships, I have non-compete fee, uh, and then which are not recognized under Ind AS, assembled workforce, control premium, goodwill. So all these three will go as goodwill in the Ind AS. So, but when I'm doing a purchase, particularly in a purchase price allocation, what is the very important thing is that the acquirer has paid a purchase price. And based on the projections that have been made, the financial projections have been made, that will result in a certain IRR, or what we call as an implicit IRR. We have to make sure that the various discount rates that we apply to various assets and liabilities, ultimately the weighted result of those assets and liabilities should be close to the IRR. It need not be 100% same, but it should be very close. So in this case, you see, I have given different rates and these are pre-tax returns. These are all pre-tax returns. Property, plant and equipment 4%, net working capital 4%, brand 19.2, orders in hand 19.25, contract, non-compete fee. Then for riskier assets, I have taken 20.25%. So my weighted average return is coming to 19.28%, and my implicit IRR is 19.3%. So this means that I have taken more or less the right discount rates to do my valuation. If the weighted average rate was significantly different than the IRR, then I would have had to go back and redo my calculations all over again, change my discount rates and redo my calculations all over again. So this is just to tell you that we have to keep this mind also. Hmm. Hmm. This is a very important factor. And of course, if we are only doing the valuation of one asset, the client comes to us for various reasons and says, okay, just do the valuation of a particular trademark or something. Then, of course, we cannot apply that, but we also then need to see what is the weighted average cost of capital and then what premium or discount we are applying, considering the factors that I mentioned before. So with this, that is all that I have, and I can take any further questions if there are.
Yes, sir.
Yeah.
How the economic life of brand can be used? Suppose BoroPlus is one brand which has longer life.
Yeah, so this is again an estimate. So normally when we say a brand is good, it has a good market position. good standing in the market. So normally we can assume that they will have a long life. Hmm. And the thing is that from an accounting perspective, we have to consider a life. It's very difficult to say that that an asset has a indefinite life. Mhm. So normally for accounting purpose perspective, we will consider 25 years or 30 years. But for valuation purposes, we can consider a projection of 8, 10 years, whatever, and then consider perpetuity. Hmm. For valuation purposes, we can consider perpetuity, but for accounting purposes, normally we will end up taking a period. So for brand, it can be much longer than the usual. If you go by the accounting standards, say AS26, it talks about a usual life of 5 to 10 years. But for items like brands, trademarks, we can take a longer life. Hmm. Again, it depends upon the type of industry and type of business, hmm, the market standing, as I mentioned. So those things, those we have to look at those things. If we talk about electronic industry, electronics can be dicey. We have seen so many electronic brands which have perished, which have gone away now. Hmm. No. So one has to see all those factors, as I mentioned about competition, also emerging competition, what kind of new competition is coming. So we have to consider all those facts before estimating a life. Hmm. So again, it's a discussion with the management, right? It's sort of, it's not just the valuer's own decision. It's basically based on the discussion with the management.
Coming
Yeah.
to next question, why we add tax amortization benefit?
That is because normally when the asset comes on the balance sheet of the company would normally get amortization for tax purposes and they will get a benefit. Say when we purchase an asset, a ready-made asset, so we capitalize it and then we take a amortization on it in the income tax or depreciation on it in the income tax and we get the tax benefit. So that is implicitly built into the price that we are paying. But when we do income approach, it is not implicitly built into the price, that value that we calculate. So we have to add on top of it. So if you go and read the IVS or the ICAI valuation standard, they have a very clear commentary on tab. They explain exactly how why tab is calculated. Hmm.
Coming to next question, which database can be taken for competitive royalty judgment?
So I've given you a list in my presentation. I'll just go back to it.
Already shared, yes.
Yeah, so just give me a minute. Uh, yeah. So here it is, royaltysource.com, ipsio.com, royaltystat.com, royaltyrange.com, ktmine.com. So there are various, and there are others also. I've just taken a few here. So if you type in Google or whatever Explorer you are using, whatever browser you are using, you will get a long list.
Okay.
So I normally use the first two. I normally use the first two.
So how did you calculate contribution from workforce?
Okay, so there is a method given there. So I talked about hmm, where did I talk about that? Just a second. So I talked about something. Just a second. Wait. So I talked about a publication which is issued by the Appraisal Foundation. So that has the examples. So if once we finish with the questions, I will try and show you the calculation on the Excel file. Yeah, next question, please.
Yes, sir. That's all with the questions. Like these
Okay,
questions.
so here it is. Here it is. The second bullet point. This is the publication. You can download it from the website, from Google. Identification of contributory assets and calculation of economic rents toolkit, issued by the Operational Foundation, USA.
Thank you, sir.
So this has the calculation methodology and everything. It has examples in it, so that you can use. So if it is done, okay. If you will just give me a minute, I will share my Excel file. How do I? Just a second. Okay, so we were talking about so contributory assets, right? So there is a method given in. Can you see return on assembled workforce here? Yeah.
Yes.
So there is a method given in that toolkit which says that you have to take start from an opening balance, and then basically you have to see what is the percentage being incurred, what is the payroll cost or the employee cost as a percentage of sales, and then you treat it as an addition to the capital of the asset of that. You treat workforce, assembled workforce as an asset, and then whatever this the percentage of employee cost that is being spent on sales, you add that as a addition to that asset. So if you see here, I have this increase during the year, and this increase during the year is actually a percentage. So which is coming based on that percentage of employee cost to sales. So then I get a closing balance and then an average balance. On that average balance, I am applying a discounting factor. So one is that I am considering it that it has a specific defined period, so it has a life because employees keep leaving. So it has a life, so I am taking an amortization, and secondly, I am taking a no. So I'm basically considering the interest. So I'm considering the interest cost on it. So in this case, this is 20.25%. So 318 here, if you see 318, so 318 is basically coming from yeah. So it's the interest cost that I'm taking here, and it is going below that table that I showed you in my presentation. Yeah, 318 here you see. So like that. So it is so basically it's the same method that I used here that is there in the toolkit.
Thank you, sir.
Yeah. So that's it. I think.
Yes, sir. It was a very wonderful session, sir. You have given through a thorough insight of the valuation of trademark. And it was really a very excellent delivery supported by a very good presentation with tables giving various methods that can be used for valuation of trademark. You have also covered accounting of trademark, need for valuation of trademark, the methods of valuation of trademark, then various approaches that can be used, giving examples of working using relief from royalty method, how to consider tax amortization benefit along with table explaining how tab is calculated. You have also explained incremental cash flow with or without method, multiple period excess earning method, then return of assembled workforce also you have explained in detail. So I am sure it has been very useful to all the participants and it has cleared all their doubts. You have also given a deep insight explanation during the whole session. And further, all the queries raised by the participants were instantly addressed and explained very well. I present a hearty vote of thanks on behalf of the team of Valuation Standard Board of ICAI and all the participants. Thank you, CA Joy ji. With this, we come to end of today's session. Thank you and have a great day.
Thank you. Bye-bye.